Hey everyone, welcome to today's The Study Trader video. I just got back from a wonderful conference by my friends over at Bloomberg on ETFs, or exchange traded funds. And I thought this actually ties in very well right now with addressing an important question that I talk about to clients and subscribers and Trade Alert members probably almost every day in some shape or form, and that is, should you be using ETFs or exchange traded funds for trading? And my answer is absolutely yes. Now, this is quite an involved topic. We will probably be doing a whole bunch of stuff around this, including coming up with a tool that we actually use internally, might release it to the public, that you can use to trade ETFs. But there's a couple really important points, and I want to particularly focus on one point. Number one, the liquidity is really important in ETFs. Do not ever trade ETFs that are not liquid, or where the underlying is not liquid. That's even more important. Okay, we can talk about that in a future video. But to me, the primary reason why someone would want to trade exchange traded funds is to eliminate what I call single stock risk. Okay, so like for example, and this holds particularly true in some of the more whipsawy types of markets, maybe like biotechnology stocks, but really almost in any kind of stock sector or group. But let's imagine this scenario. Imagine you own shares of stock XYZ in, let's say, the financial sector, okay? And you're bullish that stock. But something happens and the entire sector of stocks rallies, like every bank in the world rallies, or every financial stock, but your stock doesn't. And it can happen, and it can happen more often than you think, just by bad luck. And so the way to eliminate that and just be bullish thematically, which of course is something that we always talk about, that top-down approach, is by using an ETF. So let me show you guys quickly what this would look like. So here, for example, if we have a very simple ETF, a very simple example, I should say, of an ETF. It's the XLF Sector ETF, which represents, of course, the S&P 500 financials. I know we talk about this one a lot, but it is important, right? So right now, I could go ahead and express whatever view I might have. Maybe it's a bearish view. Let's assume, okay, this is not my current view. I'm just kind of telling you, just to kind of say, like, let's say I have a bearish view, right? Just because of this. I'm actually quite neutral right now. I'm not really doing anything until we see a bullish reversal at some point, which I don't know when that happens. So we have no position in it, just as an FYI, because I know people are going to ask. But the financial, let's just say you were bearish, right? Let's assume that's you. Again, it's not a recommendation. It's just a hypothetical scenario. You could go ahead and maybe short a banking stock like Bank of America, or buy some puts or puts price, whatever you want to do. But there is risk in that, and there's more risk in that than making a sector view. So instead of that, you could just express a bearish view in this entire ETF, the XLF ETF. Now, what I see, unfortunately, is that a lot of people who don't like to trade like a regular ETF like this, is that they say there's more juice or more movement in a single name stock. Well, that's exactly the wrong way to think about it, okay? This goes back to one of the basic things I always talk about. The way you're going to make money over time in the markets is by focusing on risk first, and then you look at reward. Risk first, and then you look at reward. If you do the other way around, and if you are attracted to never trading an ETF because a single name stock has more movement, or you look at these double inverse ETFs or levered ETFs, which do have their place, by the way, but if that's the only thing you're attracted to, you are by definition chasing reward, and that's very, very dangerous over time. So I just wanted to tell you that I do think ETFs are a great way to express a view. In fact, I think it's a safer way, but there are a couple of key things to keep in mind. Again, liquidity. Also, if you're going to use an inverse or a double like levered ETF, those are, in my opinion, just as risky, if not more risky, than a single name stock. So you want to make sure you kind of keep minimum exposure to those, unless you want to really be quick with a specific trading view. So ETFs, absolutely do trade them. We trade a lot of those with our top-down approach, which is also why the performance is very, very steady and doesn't have these massive dips. So anyway, I hope this was helpful, folks. Again, make sure to join us today in our webinar. We're going to show you guys how to generate income from the stock market in a way that, using options, in a way that I have yet to find anyone else do. Maybe that's exactly why it works, because no one else does it this way. See down below for the link. It's at 7 p.m. today, Thursday, the 28th of the 28th of August. Link down below, or maybe it's in the email that you received this video on. Have a great day, and I'll see you guys tonight in the webinar. Take care.